Let's start with the first conversation though. My first guest is Arvind Rao, who is a chartered accountant as well as a certified financial planner and the founder of Arvind Rao and Associates. Thank you so much, Arvind, for taking the time. I want to start by asking about the perception of risk before we get into each category or each asset class and talk about the risk that pertains to each of them. Broadly, you feel like you need to run away from risk. But the perception of risk needs to be a little different when it comes to investments, right?
Correct. That's right, Alex. In fact, I think, if I were to just add a point to what you mentioned, I think there are both risk seekers as well as people who like to always run away from risk. And while this may hold true in general philosophy, but I think when I generally talk to people about risk, the interpretation of what exactly risk means when it comes to investments, I get varied answers. So just to simplify things here, I think, Alex, risk is more the way our viewers should understand it is basically it's the deviation from an expected return when it comes to an investment is what generally risk could be perceived in relation to investments.
So let's drill down into each asset class and talk about how risk works in each of them. Now, in equity, there are multiple types of risk. And of course, on this program, we've spoken about the measures of risk. You talk about standard deviation, you talk about various other things. But, on the surface of it, there are some very basic aspects of risk that you need to understand when it comes to equity. How would you explain this to the layperson?
So when it comes to equities, one is what we can call it as the market risk. So market risk implies diverse movements or volatility, as we better understand it, when it comes to the market. So there could be days when markets, or there could be days or even weeks when markets have been going down consistently, as we have been seeing in the last couple of months. Or as we saw during the past years, that suddenly markets could be going up and many investors would not be able to ascribe a reason to either of these events. So this is it, that everything being equal or everything being constant, you find market movements being adverse to what the way you would expect it to work. So this is the market risk, which is the first most important risk. And second is within this is when you make security selection. So whether it is a share or whether it is a mutual fund for that matter, in both these cases lies the risk of the security risk. For example, if an investor has selected share A, the risks that come with that is if the company performance suddenly is not doing well, or there used to be a time when its profits were high, but now they're dipping, or the sector in which the company is performing has got its prospects inverted, which is why the stock may not perform. And similar reasons go for equity fund. So one is the broad level market risk, and within that lies the specific security risk that one has to keep in mind.
So, what you need to bear in mind when you're constructing an equity portfolio then, because you can't do away with risk. Risk is part and parcel of your journey as an equity investor.
Absolutely.
So therefore, how do you arrange for, and I guess we will come to the mapping of your risk profile or your risk-taking ability with an instrument. But broadly, before we get into that, when you talk about constructing an equity portfolio, how do you understand the selection of the products within that or the securities within that to adjust for that risk?
And this is interesting, Alex, because I think when we talk about risk, there are a couple of things. One is you can avoid a particular kind of risk, or you can mitigate a risk. So when we spoke about the market risk, so once an investor has made up his or her mind to invest in markets, I think one can, like you rightly said, you cannot eliminate risk that comes. There is an inherent risk in investing in equity markets, so that cannot be avoided. So every equity investor cannot avoid the market risk at all. But when it comes to the other risk, which is the security risk, I think that is something that can be mitigated. And diversification. Basically, diversification is the measure by which you can mitigate the risk in equity. So while you're constructing an equity portfolio, we cannot avoid the market risk, but the security risk can be avoided by diversifying among different securities or among different sectors as such.
So what that essentially means is that your portfolio of either stocks or your selection of mutual funds which invest in stocks has to be diverse enough so that when one pocket of the market falls, the other stays resilient. But
Absolutely.
there is also an issue that emerges when you make too many choices, or rather, if your portfolio is a little too
Over
crowded.
diversity.
Yes,
Yeah.
so too crowded. So how do you avoid that?
So it is very difficult to for an invest. I mean, and I say this because we have seen a lot of portfolios having this. I think under the guise of diversification, people tend to restrict the security size to a small amount, and every time they make a fresh investment, they tend to get into another stock or another fund. So I think this is basically an investor mentality which one has to try and control. And there cannot be a thumb rule in terms of how many stocks or how many funds one should have. But I mean, let me put a number. So if you're having an equity share portfolio of, let's say, 10 lakhs, then in my view, you should not have more than 10 or 12 scripts in it. And this number varies as the portfolio size varies. But we have seen people having multiple stocks even within a 5 lakh portfolio. So I think this is something that they should avoid, because not only does it lead to over diversification, but at the same time, if there are select stocks which are showing positive movement, when you have a lot of stocks, it reduces the number of units that you're holding for that particular stock, which will also bring down the gain that that particular stock is adding in your portfolio.
Point. Let's talk about fixed income and physical assets, and then we'll talk about overall risk in a portfolio. So in fixed income, by my understanding, Arvind, there are two types of risk, especially if you're talking about investing in bonds. In fixed deposits, obviously, it's essentially you're not taking, or rather the risk is less to that extent because it's a fixed product. But because it's tradable, you have bonds that have two types of risks. You have duration as well as you have credit risk. How do you explain these?
So credit risk is, I think, which our viewers will be able to easily comprehend, which is when you're investing in a company who is issuing a bond or a debenture or a fixed deposit for that matter. If something goes wrong with the company and it affects its capability to repay the bond or the debt that they have raised, that is the credit risk that an investor carries. And generally, the returns that are offered by these bonds are reflective of the credit risk, meaning the higher the return offered by these debt instruments, that in a way speaks about the higher credit risk that a company is offering to its investor, or is inherently what do we say, imbibed in that company who is raising that debt. And speaking about the other, which is the duration risk. So duration risk, actually, this is a fantastic time to talk or discuss about duration risk, because what happens is the yield of a debt instrument is inversely proportional to the price. So what happens is, like, for example, in the last, I think 6 weeks now, there has been almost a 90 basis point increase in the repo rate, which has led to increase in the fixed income yield. Now, what happens is investors who are holding existing fixed income instruments, which are having a rate that is lower than the increased rate, since the general rates have gone up, the price or the tradable or the market price of these instruments having slightly lower rates of interest will also go down when the interest rates move up. So when we talk about duration, it depends upon what is the tenure for which you are holding a fixed income instrument. So at today's date, if you are holding a medium to long-term instrument, that is where the duration is longer, then there is a chance that the effect that it will have on the price of this bond will be significantly higher for the one which has a lower duration. So I think in short, what our viewers need to keep in mind is that keep an eye on the yield, keep an eye on the price, because both of them are going to move in the opposite directions at a given point in time.
Especially in this time, I think it is being said that because on the longer duration bonds, which you just pointed out, the duration risk is more, you should ideally try and stay on the lower end of the spectrum unless you're holding hold to maturity bonds, in which case there is no fluctuation in the price.
Correct. Either you hold it, or basically, I think it's the mindset that I am not going to sell this bond independent of what the movement is. I'm going to hold it till the maturity, in which case the yield is like kind of sealed.
Absolutely. Target maturity funds can be used to mitigate that duration risk. But let's talk about physical assets, because I don't think that this is spoken about very often, Arvind. The risk involved in buying gold, or the risk involved in even buying jewelry, or even real estate. What is the risk here?
So let me start with real estate, because I think one of the primary risks in real estate is what is called as the liquidity risk, meaning very difficult to. Generally, as you see that you may be having a property, and people tend to look at its value by pegging it to the nearest locality sale that might have happened at a particular price. So on paper, your property may be valued at an X value, but it is very difficult to be able to sell that same property at that given value at a given point in time. Because what you need is, because I think in real estate, value is very subjective. So you need to find a buyer at that point in time who is willing to pay your price, and that is exactly the liquidity risk which I'm talking about. That although you may be having property or multiple properties which may be seeming highly valued, it may be difficult to convert this into liquid money at your beck and call. Normally it says the real estate can take anywhere from 3 to 6 months or even a year sometimes to be able to dispose it off, and that too, getting the market price may be a challenge there. Speaking of commodities like gold and silver, I think what has happened is I would put it more like market risk for that.
Please go ahead.
Yeah, sorry. When we talk about gold, silver, and commodities like this, they don't have liquidity risk, because I think if you discount the current price at which it is going, gold is something which is extremely liquid. You can just walk into the nearest store and you'll be able to realize the price, maybe minus whatever the amount that they deduct on account of various factors. But the risk that I feel when it comes to gold is that since it is globally traded, it is the market risk. So every day the gold price keeps fluctuating, and because it has become an asset class by itself now, it is prone to the demand and supply factor, which automatically means that the gold prices are not in an investor's control. It is widely impacted by the way globally the direction that the commodity is taking.
Fair enough. Coming to the most important point, which is how to utilize risk and how to choose your investments basis risk, right? One way to look at it would be to judge your risk taking ability as a whole, or look at your risk profile, as they say, and choose the investments that you want to make accordingly. The other would be to look at per goal, which according to you is the more important or the better approach to take.
Alex, and this question intrigues me every time I'm asked this, because what I've seen is when a person's risk profile is let me correct. When a person's risk is profiled, I have found that generally there are a series of questions you may ask, and you determine the risk taking ability basis the answers to those questions. But what happens is this is very psychological, and an investor generally is very volatile. So when you ask a specific question, like for example, if your investments are down by 25%, what will you do? Now, an investor's answer to this question varies basis the environment in which he or she is at that point in time. So during better times, an investor tends to say that no problem, I am a long-term investor and I will tend to invest more when the investments are valued down. But if the same question is asked during a not so good time, the answer could be no, then I don't think I'm comfortable with this kind of an investment. So this makes taking decisions based on the risk profile of an investor very difficult, because not only there is market volatility, there is also investor mindset volatility there. I find generally mapping it to a goal. So you profile the risk of the goal. That is, if the goal is to be maturing in the next 10 years or 15 years, so independent of the investor's mindset, you can tend to take a higher amount of risk in that, because one more thing here is that risk is also inversely proportional to the time. So that means, what I mean to say is, the longer the time available to an investor or for a goal, lower is the risk, because as time moves, risk or volatility averages down, and there is a higher chance of getting better yield on a longer time. So if you attach an investment and a decision is made based on the goal and the time horizon that it comes with, I think eventually in the longer term, an investor is set to benefit more in that case.
I think it's been a very comprehensive conversation. We've covered all aspects of risk. And hopefully that this conversation has helped people make their decisions a little more confidently than before. But thank you so much, Arvind, for taking the time.
It's my pleasure, Alex. Thank you.